Good morning and welcome to Gray & Gray's Fiscal Cliff webinar for the members of PGANE. My name is Jeff Foley and I'm a partner in the Energy Practice Group here at Gray & Gray. Many in the propane industry felt that we've dodged a bullet when Congress reached a compromise agreement that avoided the automatic spending cuts and tax increases that would have been brought on if we had gone over the so-called fiscal cliff. However, not all the results are positive from the business community or individual taxpayers. Luckily, we have Mike Coppella, who has been following the ups and downs of the tax landscape for over 30 years and has been right on top of the fiscal cliff negotiations from the start. Mike's expertise in this arena, coupled with Gray & Gray's 65 years of experience in the energy field, make the information we are presenting today essential for your business. At this point, I would like to introduce my partner, Mike Coppella.
Hi, everybody. The way I like to do this is I have a couple rules that I like to have. First, there is Jeff's picture. You can notice that he is young and handsome. And there is me, and you'll notice that I'm not so young. But the easiest way to get a hold of me is you can call the office and ask for my line. My direct number is there. My cell phone number is there. And my office email address is there. And you can use any one of those if you have any questions to get a hold of me. Let me tell you another rule that I have is it has been my feeling for the 30-odd years that I've been speaking that a presenter should try not to be political, and I will try very hard in this very political atmosphere that we have today to keep whatever my political views are to myself. If you have questions, you can feel free to type in questions, and you can be as political as you want. If you get overly political, I won't repeat or answer the question, but let's go forward and assume that everything will be fine. So, long ago, I was taught by my tax mentor almost 40 years ago that there is a basic concept that we as tax professionals have to remember, and that is don't let the tax tail wag the economic dog. And by that we mean that we have to remember that we are business people, and our job is to make economic decisions that are best for the business. And yes, taxes have to be considered, but we shouldn't be doing things exclusively for tax reasons. We should make sure that what we're doing is we're doing them for good, solid business purposes. Okay. There are a couple of quotes I want to give you that I found humorous as this came out, and we should have a little bit of levity in our life here. And the first quote is, "Thanks to Congress for keeping its wayward members off the roads and out of the bars on New Year's." I apologize for that being a little political, but I found it kind of funny at the time. The next thing is, if you remember, right after this legislation came out, a lot of senators and congressmen said, well, this isn't the best we could do. This is the best we could do in a short period of time. But basically, it's the best we can do. So this is kind of interesting, where it talks about the morning after, as so often happens, there were regrets. And the one that I found most interesting, and you have to understand the political landscape. The political landscape is a lot of give and take and back and forth. And one of the things that we often hear about is something called earmarks. And what an earmark is a piece of legislation that is inserted in order to benefit a very, very small group. Sometimes that group was as small as one taxpayer or one corporation. And this came from actually one of my friends who said he scanned the entire fiscal class bill for best tax breaks, algae and economic development in American Samoa. And that actually is in the legislation, which I just found kind of fun. Now, one of the things that the legislation was supposed to do is to protect middle-class taxpayers. I'm not going to try and define what middle class is. Everybody has their own definitions. But what is very interesting here is that one of the things that definitely affects most middle-class people was the payroll tax holiday, which was a 2% reduction in your payroll taxes. And so basically what now happened is the payroll tax holiday was not extended, which means that if you have a family of 4, for example, and they make $70,000, their taxes just increased by $1,400. And you can multiply that up all the way up to the $113,000 or so limit on payroll taxes. But this is very interesting when we talk about protecting the middle class. Now, one of the things we were relatively sure was going to happen, based upon the desires of President Obama and the Democrats and where money can be gotten, is that the top tax rate was going to go back up to 39.6%. What we didn't expect is that it's a much higher level than we expected. And one of the things you're going to notice if you follow taxes like I do is that we now have a myriad of definitions of who is rich. You may remember that those of you that have attended other seminars that we've talked about, that the net investment income tax and the additional Medicare tax both start at marriage filing joint adjusted gross income of $250,000 for married filing joint and $200,000 for single. In this case, rich is defined as $400,000 for married filing joint and $450,000 for married filing joint and $400,000 for single. One of the other things that if you look at this you'll see is one thing that people touted that was accomplished was that they avoided an additional marriage penalty. If you look at this, you'll see that the 39.6 tax rate, as well as when we talk about capital gains and dividends, there is a marriage penalty built in. So that basically if you have a couple, each of whom makes $300,000, neither of them would be taxed at the 39.6%. However, put them together and they make $600,000, and all of a sudden you now have $150,000 taxed at the 39.6 tax rate. So what we see is a built-in marriage penalty here. One other thing I want to point out at this juncture is that when we talk about the alternative minimum tax later, and we're going to talk about indexing and how important it is to index exemption amounts and bracket amounts, one of the things that is very interesting that we're going to have to talk about is that the 39.6 bracket as well as the capital gains bracket, those brackets are not indexed, which means that basically that isn't going to increase, and slowly but surely the number of people that are going to be subject to both of these taxes is going to increase because we don't have any kind of indexing in this area. Capital gains and qualified dividends are now going to be taxed at 20% instead of 15%, which is a huge, huge increase. There are a couple of things that we want to talk about in this area. The first one is if you made an installment sale in 2012, one of the things I want you to consider is the possibility of electing out of installment sale. All right? And by electing out of installment sale, what you're going to do is you're going to tax the entire amount at 15% rather than the amounts that are paid later at 20%. However, there's a risk here. And the risk is that if in the future that installment is not paid, then what you're going to have happen to you is you're going to wind up and you're going to have a situation where those unpaid amounts are going to be treated as capital losses. And as we unfortunately know, capital losses can only be used to offset capital gains, or they're used at $3,000 a year. So that basically, if you're electing out of installment sales, and a lot of articles have been written about that, you have to be very careful to make sure you have it. One of the other things that is interesting and applies to your industry is what happens on the sale of real estate, for example. A lot of people in the industry own the real estate that they're on, and therefore basically usually in another entity. All right. So, but what happens here is if that is sold, there's going to be recapture on that depreciated amount, and that recapture is going to be at 25%. That 25% did not change in this legislation. So basically, whereas the differential between capital gains and recapture of real estate used to be a 10% differential, it's now only a 5% differential, and that is something that we're looking at very, very closely. All right. The threshold here is the same threshold as it was for the 39.6% bracket, And one of the other things I want you to remember is that capital gains, most capital gains, all right, and if you want to talk in specifics, please give me a call, because certain capital gains are excluded, like sale of principal residence and sale of business assets are excluded to a certain level. There's an additional 3.8%. So, for example, if you're selling Apple, for example, if you were lucky enough to own Apple stock or IBM stock or whatever, a long time ago I used to say GM stock, at a relatively low basis and sell it for a capital gain, your capital gains rate isn't going to be 20%, assuming that you're over the $250,000 adjusted gross income. What you're going to wind up having is a 23.8% tax. That's a 60% increase in capital gains, and that's something that you really have to look at and you really have to plan in this situation. Now, one of the other things, and a lot of small business people, a lot of closely business people have set up trusts for their children or for their spouses or whatever in order to minimize taxes. You have to be very careful now what you're doing in this area, because trusts and estates do not escape any of these new taxes. So what you're going to have to do is you're going to have to do a lot of planning to make sure that you make distributions in order to minimize the tax, the combined tax between you, your business, and any trust that you've set up, because it just gets more and more and more complicated with regard to estates and trusts. Now, what I strongly recommend is that for almost anyone that has significant investments or anyone that has trusts, you really have to sit down with a very, very qualified financial advisor towards the end of the year, middle of the year, and have them help you in deciding what you should be doing as far as making distributions out of trusts, selling assets, and so on. We are very, very lucky at Gray, Gray & Gray. We have Dan Romano, who can help you in this area, who's really extraordinarily good at all of the planning that's involved with financial planning and retirement and estate planning. Alternative minimum tax. I don't know exactly where all of you are from, but if some of you are from high tax states like Massachusetts, like Vermont, like New York, like our son out in California, which are high tax states, it is very common that you're going to be in the alternative minimum tax. So that basically what you have to do is planning is going to become extremely important in dealing with alternative tax. The indexed amount has been extended permanently, and we'll talk about what permanently means towards the end. But basically, we have to really concentrate now with regard to AMT planning because of some of the things that we have seen. And again, some of the things we're going to see when we talk about phase-outs of some of itemized deductions and how that's going to work back and forth, as well as what's going to happen with some credits that you may or may not have. Speaking of credits, what the legislation allows is that non-refundable personal credits can be used for alternative minimum tax. Now, I don't want to get into what personal credits are, because what I really care about here are business credits. So a lot of business people have various business credits that flow through on from their pass-through entities to their personal tax return. So, for example, if you take advantage of work opportunity credits, for example, or if you take advantage of business environmental tax credits, what's going to wind up happening is you're going to be able to use those credits against your regular tax. However, you're not going to be able to use those credits for alternative minimum tax purposes. So all of a sudden what you're going to see in those high tax states for people that are already in alternative minimum tax is you're going to see that a lot of those credits are going to wind up not being able to be used, being wasted, which is just going to further increase how much people are going to have to pay attention to all your alternative minimum tax planning. All right. I want to talk about phase out of itemized deductions. They are called the P's limitation. Now, once again, we have another definition here of rich. And in this case, rich is defined as $300,000 for married filing joint and $250,000 for people who are single. But what happens to these people, and this is based upon adjusted gross income, bottom number on page 1. So what happens here is kind of interesting. All right. First thing you have to recognize is which itemized deductions are going to be limited. And what's interesting is who's not limited. So that basically your medical expenses, investment interest expense, casualty losses, and my favorite in this category, wagering losses, will not be phased out and are not limited in this situation. But think about what that says, will be limited. What this means is that your home mortgage interest, your state income taxes, your real estate taxes, all of those items are going to be subject to phase out, subject to limitation. All right. In addition, the other one that is included is charitable donations. So that means that when we're doing these things, we have to be very cognizant of what year we're doing, and we'll talk about bunching in a minute. But charitable donations are going to be subject to phase outs. And up to 80% of these itemized deductions can be phased out, and they're phased out at a rate of 3% of your amount in excess of adjusted gross income. So, for example, if you have $1 million of adjusted gross income, and remember that's the number on the bottom of page 1 of your tax return. If you have $1 million of AGI, 300 minus $300,000 means $700,000 will be subject to the phase out, times 3%, or $21,000 of those itemized deductions are going to go away and will not be available to be used for regular tax, which is a major, major hit for a lot of people when we start talking about that being done presumably at like 39.6%, which means that about $8,000 of additional tax because of the phase out in our example. Bunching becomes important. Think about what we said. Depending upon where you stand in your phase out, depending upon what you have for itemized deductions, we're going to want to take a long, hard look at when you take certain itemized deductions, when you make a charitable contribution. Do you pay your real estate taxes early, et cetera, in order to maximize the amount of itemized deductions that you're going to get and minimize the amount that is subject to the phase out. That's something we'll be talking about a lot at the end of the year at our year-end tax seminars. But once again, this is something that you have to be very cognizant of pretty much all year round. The next big hit is you also are going to lose your personal exemption amounts. So that basically what's going to wind up happening here is that, once again, starting at the same $300,000 married filing joint and $250,000 for single, anything and every $2,500 in excess of those amounts, you're going to wind up losing 2% of your itemized deductions. So basically, by the time you reach something like $450,000 for married filing joint, you'll have lost all your exemptions, which is very, very costly indeed. All right, so that between the two of them, you can be looking at well in excess of $20,000 of additional tax for people making more than $1 million. All right, so that basically this is something we have to pay very close attention to. One of the things that we used to do long, long ago when we used to have the personal phase out previously is we used to take a look and see if there was a way that we could not take the exemptions on our personal returns because they were going to be phased out and let the children, your exemptions, your dependents, take it on theirs. That's a very tricky situation, but it's one that you really have to sit down and see whether or not you can find a way to do it. And that's, again, something we'll be talking about at our year-end tax seminars as far as how we can plan on doing that. This is not going to affect a lot of people, but it is a very important financial planning situation. The vast majority of businesses have 401ks. All right, it is, it is the way that people plan for their retirement today. Now, basically, what now we can do is that anyone, regardless of age, can take and convert from a traditional 401k to a Roth 401k. Now, I don't want to spend the time right now to go through all of the advantages and disadvantages of a Roth versus a traditional, but there are a lot of advantages and a lot of things that you have to think about. Once again, if you have a significant 401k and you're thinking about doing any types of conversions from a traditional to a Roth, I strongly suggest that you sit down with a qualified financial advisor. Call Dan Romano in our office, email me or call me if you want, and I will see if I can help you. But this is a very, very important consideration with regard to possible retirement. Education, basically all the education amounts, as you can see there, are all extended. I don't want to spend a lot of time because they really don't affect that many people. Once again, all the other individual items as listed here are also all extended. All right. Now, what I do want to make you aware of is the last one, and that's capital gain property donation for conservation. A lot of people donate conservation land, easements on their property to conservation people. A lot of people in various cities, what they'll do is they will donate the facade of their building to historical preservation. The IRS is coming down and looking at these very, very closely. If you are considering this, I strongly, strongly recommend that you give us a call. We're very knowledgeable in this area, and we can help you and tell you exactly how bad your exposure is in this area. Now, you'll notice my graphic here with regard to gift and estate, and is one of complete surprise. And the surprise here is that basically we thought the exclusion, the amount that can be excluded for gift and estate and generation skipping, we thought that was going to be reduced. And the surprise was that what they basically did is instead of reducing it, they took the $5 million that was in place, and we all talked about it for purposes last year and setting up trusts and making up gifts and everything else because we thought that exclusion was going to go down. What happened is that exclusion was made permanent and it was indexed. So in 2013, that exemption actually increases to $5.25 million, which is really important. The other thing that's important is the concept of portability. The best way to explain portability is that let's suppose that the wonderful Tina and I have not made any significant gifts to our children, and I'm off hiking in the woods or cross-country skiing, and basically if I'm cross-country skiing, I'm not going to meet a bear because they're all hibernating, but I get run over by a moose and die. All right? Basically what portability says is that means that the wonderful Tina will get whatever exemption I have not used, so that based upon this, she will have over a $10 million exemption for estate tax purposes, which is absolutely astronomical when you think about it. The only bad situation is that the maximum tax rate was increased from 35 to 40%, which is still better than we thought was going to happen. And it was made permanent, and there were no other changes. And I really want to emphasize this no other changes. One of the things that is considered fairly low-hanging fruit in this area are a couple of things. There's been a lot of talk about making discounting, especially for closely held stock, go away. So one of the things that you want to talk about in family-owned business and closely held business is what we talk about is passing things on to the next generation. So what happened in next gen succession planning. So what we were able to do is we were able to take, and let's suppose that we took and we gifted one of our children, let's say it's $3 million of assets of worth of our company, of our propane company. So that basically that would mean that he gets 3%. However, by proper discounting, instead of it taking $3 million of our exemption, we can do it so that it will actually only take about $1.8 million of the exemption. So this is a very powerful thing. It is low-hanging fruit that is out there along with some other things. And we have to be very cognizant of what's happening in that area so that we see what's happening. But this is a very, very important area. Now, we'll get to the definition of the term permanent in a little while, but this is really, really a surprise. If you did not take advantage of gifting in 2012, I'm recommending to people that they take another look this year because I think that even though this says permanent, I don't think it's as permanent as people think it is. Why are gifts still important? Right. Depending upon what state you're in, and I'll use Massachusetts, that's where our offices are. Right. In Massachusetts and most other states, they have either an inheritance or an estate tax. What they do not have is, with very few exceptions, is a gift tax. So basically what we're seeing here is, let's suppose that you have a large estate. In Massachusetts, the estate tax can be as high as 16%. However, Massachusetts has no gift tax. So that if you gift your assets before you die, you avoid that estate tax. If it's included in your estate, other than if it's going to your spouse, then what you're going to wind up with is you're going to wind up with a pretty significant state estate tax. So that even if you're below the federal exclusion amount, you should still be talking about whether or not you should be gifting in order to avoid the state estate tax. And once again, that's something that we can help you with in our office in looking at. 179. 179 is really very, very important in your industry because basically you guys are a capital-intensive business. You have lots of trucks. You have lots of tanks. You have other things that are depreciable. So what happens here is 179, the ability to immediately expense assets is very, very important. And again, this caught us a little bit by surprise. The 179 was extended for 2012 and 2013 only, all right, at the same $500,000 and $2 million starting for the phase-out amount. That's very, very important. Now, one of the things that you might want to talk about, depending upon how much your purchases are, is that I know that in the industry, sometimes the tanks are owned by you, and sometimes they're owned by the homeowner or business owner that is buying from you. So you might want to take a look at how you're going to do this, if this does affect you or not. But remember, you've got $500,000 a year for 2012 and 13, and the phase out of that amount doesn't start until you reach $2 million. So this is something that is very, very important, very, very important in just looking at what you're going to do and when you're going to purchase assets. The same thing is true of bonus depreciation. Bonus depreciation was extended again, not at the 100% level, but at the 50% level, so that basically bonus depreciation applies to purchase of new assets, never used before assets. So if you buy a new truck, one that has never been used before, you will be able, in bonus depreciation, to take half of the purchase price of that truck and depreciate it immediately. And you may be able to make the rest of it go away through 179. If, however, on the other hand, if you bought a used truck, then if that's the case, bonus depreciation will not apply because it only applies to new assets. All right. That's so that this, again, only applies for this year. All right, and we'll have to wait and see what happens in future years. Okay. Business credits. Business credits, basically almost all business credits came back into play. R&D credit, which really doesn't apply extensively to your industry. Some of you, I know, use work opportunity credits, which is a credit for hiring certain classes of employees, and basically Once again, this is retroactive and valid through 2013. Now, one of the things I want to make sure people understand is that there's a special work opportunity credit for disabled veterans, which we should all be looking at anyway, and all your other business credits, all your environmental credits and other credits are also valid through 2013. Remember, the vast majority of people in your industry are pass-through entities. They're S corps and LLCs. So what this means is as we said before, if you have these business credits, you'll be able to use them on the pass-through entity for your regular taxes, but not your alternative minimum taxes. So there's a great deal of planning if you have pass-through credits that we have to sit down and talk about and make sure that everything is taken care of properly. The tax situation, we have to plan. There's a tremendous amount that's going on this year. Not only are there these new taxes, but also all the new taxes for PPACA, Obamacare are kicking in this year. I don't want to get too deeply into those. We'll talk about them just a little bit. First thing I want to talk about is net investment income tax, the 3.8% tax. Basically, what we know here is that there is a very extensive, very complicated set of regulations that were issued a couple of months ago. Several organizations, including the AICPA, and I was fortunate or unfortunate enough, depending upon your point of view, to be asked to make comments for the AICPA on certain parts of this. But basically, once we get the final regulations, which we expect sometime early in the second quarter, no guarantees, but that's what we expect. Once we get that, we'll be distributing a lot of more information about how that applies. One of the biggest issues, and the one that I was charged to make comments for, is basically the sale of part of a company. So let's suppose, all right, that you're sitting there and you want to do some succession planning. And what you want to do is you want to take your business and you want to sell 20% of your business to your son or daughter. And you've gone out and you've got a valuation of the business, right, which is usually what you do. What most business valuators do is they do a valuation of the entire business of the company and then move forward. Basically, what the regulations as they are now written say is you can't do that. You have to go down and get a valuation on an asset-by-asset basis, which, my comment was I didn't think that made a lot of sense, and I gave a bunch of reasons for it. But it is something that we'll be watching very, very closely, as well as the code says that interest and dividends and so on at the business level that is used by the business and generated by the business is not subject to net investment income, and we're waiting for more definitions on that from the regulations. A couple of things I want to talk about with regard to earned income. You have to remember, you have to remember that part of this is that earned income in excess of the levels we talked about, $250,000 worth of earned income in a married filing joint and $200,000 for single, and we can talk about how that works if you have questions. But basically, anything in excess of that is going to be subject to 0.9%. So that basically what that says is, and let's make our math simple. Let's suppose that you have earned income of $950,000 and you're married filing joint. So $950,000 minus the amount of $250,000, that's $700,000 times 0.9% of, or $6,300 of additional tax. I have a question. Is there more funding for IRS agents, and are there more certain targeted areas you're seeing now? That's a great question. And let me tell you the answer. The answer is kind of interesting. As you may or may not know, coming up on May 1st, we have the sequestration situation, major cuts in funding for many different types of business expenses. And what is interesting is one of those areas that is subject to being cut is actually the IRS. And the IRS actually came out, for nerdy people like me that read all the stuff that comes out of their office, they came out and said that if nothing is done and their budget is cut by sequestration, they're going to have to furlough some of their employees. So that basically the question is, will there be more IRS agents? That depends on what their funding is and whether it's cut by sequestration. Now, one of the biggest things, and we're going to talk about it in a little while, I want to talk about here, we're talking about S-Corps. One of the things that they're looking at very, very closely is the IRS is looking extremely closely at the question of shareholder employee wages. So that basically the law says that the amount of wages that a shareholder employee gets must be reasonable. And basically they obviously have the ability of hindsight. And one of the criteria that they're going to use, that they've already told us they're going to use, is they're going to take a look and they're going to say, how much of the earnings of the company are being taken as wages as to how much of that is being taken as a pass-through. So, for example, if you have a company that makes, hopefully for all of you, $5 million, and you take $1 million as wages and take $400,000 as a distribution from your K-1, the IRS could very likely come in there and say, why did you do that? Why is there 4 times as much coming out as a distribution as there is as wages? What we recommend, we actually recommend that you actually put this in writing, and we do this for both S-Corps and LLCs, is we recommend that you have an annual stockholders or members, in the case of LLCs, meeting, and the amount of the compensation be specifically written, all right, at the meeting, as how much it is and why it is. And that documentation will put you in good stead in the future. So S-Corps, you have to be very cognizant of that, because in the S-Corp environment, your wages are subject to the 0.9%, and the distributions from your K-1 are not subject to the 0.9%. Now, in the LLC environment, and I don't want to spend too much time on this because it's a fairly complicated situation, if your business is operating as an LLC, it's very, very important that you do something called bifurcation. And what we do in bifurcation is we take the managing member, and that managing member becomes a 1% managing member. Somebody else, which can be their spouse, can be a 20% non-managing member, and the managing member also becomes a 79% non-managing member. And in that situation, only the 1% income is subject to SE tax, including the 0.9%. What we do is we also make a guaranteed payment, and we do the same thing with LLCs that we do with S-Corps. We sit there and we say, okay, we absolutely have a meeting. It's written right in the LLC operating agreement that basically says, and I probably said this now 75 times in the last 10 years, all the members will vote on an annual basis on the amount of the managing member's compensation in compliance with Internal Revenue Code Section 707C. And like I said, I probably said that 50 times in the last 10 years. I've defended it 8 or 9 times in the last 10 years, and we've never had a problem as long as people have followed the documentation that we suggest and everything is properly lined up. We know how to do it. We understand how to do it. The other thing I want to talk about with regard to PPACA Obamacare, if you are a larger company, if you're a company that may have 50 full-time equivalent employees, and if you want to know what that means, give me a call or email me, and I'll go through the whole definitions of full-time equivalents. But if you have that, it is very interesting when you start counting for that, when you start making the determination as to whether or not you make it, because you can do that prospectively, looking into the future currently, or retrospectively, meaning you could start doing it in 2013 to be effective in 2014. So that's something that is very, very important. It is something that you have to look at, and you really have to sit down with a very, very qualified person in the health area to make sure that you're doing this. We are going to be partnering with some people to have a seminar on this later in the year. And if you're in the area, we strongly hope that you come to that, because all of this is going to be covered, and it's a very, very important area. Repair regs. As I said, many of you are sitting there and you own your real estate either in your operating entity, or you were told a long time ago that you shouldn't have the real estate, you shouldn't have your real property in the entity, it should be outside of your entity. Now, the repair regs, which came out initially in December of 2011, their effective date has been postponed to 2014. However, in some situations, especially a situation where if you own your real estate, and for example, if you replaced your roof in the last 2 or 3 years, you may want to sit down and talk about early adoption of these regulations so that you can actually go back and take a significant amount of expenses when you repaired that roof that were not otherwise available. The final regulations in this area are due out sometime in the second quarter, sometime in the spring. We'll be following that very closely. Basically, based upon our experience and my discussions with a couple of committees that I'm on in this area, it is going to affect the vast majority of businesses. It is going to affect, for example, major repairs that you do to your truck engines. It's going to affect if you stock tires, what you can do with rotatable parts. All these things down the line are going to be involved in what this is going to do. It is going to absolutely change the way most businesses think about whether or not they have to capitalize or whether they can expense. When we say repair regs, we're talking about any capital purchase, and it is absolutely going to change the way you think. And when these final regs come out, we'll have some seminars and so on with regard to what has to be done in that area. I want to tell you a funny story, or maybe it's not just a funny story. There's a new case revolving around worker classification, and worker classification is the worker your employee, or are they an independent contractor? And as an independent contractor, that means that you don't have to withhold payroll taxes, you don't have to pay payroll taxes, you don't have to pay workers' comp, you don't have to pay their health insurance, you don't have to pay unemployment, and so on. So that basically what happens is the person is less expensive for you to maintain. Now, somebody asked before, what is the IRS going to be looking at? The IRS and the Department of Labor have absolutely indicated they're going to be aggressively looking at whether or not the workers of a business are an employee or an independent contractor starting in 2013 and 2014 because of what happens with health care and the calculation. And I don't want to get deeply into the health care, that's an entirely different subject, but what happens with regard to the calculation of the 50 full-time equivalent employees and the 30 full-time employees that come in the calculation of, do you have to provide health care, and what is your penalty if you don't? Now for my funny story. I am told, and I do not go to strip clubs, so let me start with that. But basically, there was a strip club out in the central part of the country, and they treated their exotic dancers, strippers, as independent contractors. And the strip club closed, and the exotic dancers went and filed for unemployment insurance. And they said, we're employees. And they pay him back and said, no, you're not. You're independent contractors, and you're not subject to getting unemployment insurance. And they fought it. And basically what came down is they said that because the strippers, the business controlled when they go on, and some of the things, it's so funny, some of the things they could and could not do with patrons, because of that, they were not independent contractors, they were employees. And therefore, the company, even though bankrupt, had to go back, and any assets that were available actually had to go back towards paying the workers' compensation and unemployment compensation for these strippers. And on top of that, because some of the strippers did not pay all of the taxes they should have, the company and the responsible people, and we can talk at length about what a responsible person is, but those people actually had to dip into their pockets and pay some payroll taxes that should have been withheld from these people as employees. So this is a very, very serious situation. It's one that you really have to pay attention to. The question said, what are we seeing? The IRS and the Department of Labor are coming down very, very hard in this area. Now, I will tell you that the IRS and the Department of Labor have a semi-amnesty period in order to fix this, which currently expires the end of June. If you think you have any issues in this area, I strongly recommend that you pick up the phone, call me, call an employment attorney, and we sit down and talk about what has to be done in this area, because this is absolutely one of the areas that they are focusing on. We talked about sequestration coming, and you know that the debt ceiling is coming. There is more to come. Basically, we already know that it would not surprise us if either for sequestration or debt ceiling or both, we see some significant tax increases of some type. We'll be following that. We have to remember the sequestration discussion comes up very, very quickly, since that's supposed to take effect on March 1st. And we have to see what happens in that area. One of the other things I want to remind everybody, I've been doing this for a long, long time. And one of the things that I have learned is that in taxes, the definition of permanent is until Congress decides to change it. So just because what we saw here was that people were, some of these provisions were permanent, does not mean that we're not going to find out that they're all going to be changed, and some of the things that are permanent are going to be not so permanent. Does anybody have any other questions that they would like to cover before we adjourn? I don't see any, and I don't see anybody has emailed any to me. If you have questions, I know a lot of people have problems in asking questions at these webinars. Feel free to email me. You have my email down there. You can call me. You can call my cell phone. You can call the office, either one, and we'll be happy to help you. I want to thank all of you for coming. This is a major, major situation where a lot of tax situations are changing, and changing very rapidly. So thank you very much. Let me look one more time here. Wait a minute. Is there more funding? Oh, wait a minute. Is the marriage penalty going to stay in place? Great question. Is the marriage penalty going to stay in place? I think it is going to stay in place. I mean, basically what we saw is that in Obamacare and in TRA 2012, we saw marriage penalties in both situations. I think that we're going to see more and more marriage penalties. So, yes, I think it is absolutely going to stay in place. I will tell you that there is a movement by some organizations to try and get a technical corrections bill as far as some of this is concerned that we're working on. I don't want to get into exactly what things we're talking about right now because we don't know what's going to happen. But I would say there's only like a 20% chance of there being any major technical corrections with this, which means that, yeah, the marriage penalty is absolutely going to be here for quite a while in all of these situations. Okay. Thank you again, and you can reach me any one of those ways. Thank you very much.